And welcome back. Week 4, Mortgage Market Movers Weekly. We had a big week. It seems like every week's a big week now. Always something going on in the market. It has been so incredibly volatile. You see big spikes throughout the day, big drops. So we are here to keep you informed, let you know what's going on in the market, letting you know why the volatility is there, and what does that have to do with mortgages. So TLDR, if you don't have the attention span to stick around for the rest of the video, mortgage rates have gone down week over week. Last week it was 6.95 was the average for a 30-year fixed rate mortgage. This week, 6.86, I believe. I have to double check that. But if you stick around for the rest of the video, you will get confirmation that that is the actual rate. All right, so last week, like I said, we had some big stuff. We had unemployment data come out. We had inflation expectations data come out. This next week also have we have some stuff going on. I don't think it's going to be as big as last week, but we will check the economic calendar and see what's going on. All right, so let's get to the charts. All right, and we are back at the U.S. 10-year yield. Again, the yield is not what the mortgage interest rates are, but they are a good proxy. So we can look and see, are mortgage rates heading up or are they heading down? Typically, there's a spread of 1.5% to 2% for the yield versus mortgage interest rates, depending on the lender, depending on the bank. So a very, very, very loose rule. You can look at the yield and you can add 1.5% to 2%, and that is around what the average 30-year fixed mortgage rate will be. So we were climbing up there January 14th, 4.809. Really, we wanted to stay away from 5%. If you remember last week, I was saying 5% was kind of this, right here. And that's where rates were back in 2023. We didn't really want to get above that. As you get up there, this is a potential point where if we got up above this level, then we were kind of in this danger zone where rates could keep rising. And the next, let's see. Yeah, I mean, that's 3. Nope. Basically, that's the highest the rates have been in a while. Okay, so this is back in 2022, and this is 2020. My apologies. And if you remember, I mean, rates were in the 2.5s, 3s back there. So as you can imagine, we don't want to get up above 5% for the yield. So rates have been coming down, and let's look to see the bond market to see why that might be the case. Remember, there's an inverse relationship. As bonds go up, yield typically goes down. The yield is the incentive for investors to invest into bonds. So we see this, and bonds have kind of been coming down for a little while. Bonds are a more risk-off asset. Investors typically want to put their money in the stock market, in equities, securities like individual stocks. They might want to put it in the overall stock market, the S&P 500. And when things are going well and the S&P 500 is heading up, you might see that bonds are heading down. So bonds have been coming down for a little while. I think in 2024, I mean, we had a rally of 24% in the S&P 500. So the market gave back 24%. Of course, you're going to throw your money in there more so than the bond market. But bonds are coming back a little bit. I mean, we see this uptick. And I think probably the reason that is there are people that are concerned about inflation. There are people concerned about a potential recession. And we are going to look at the data to see, are those fears justified? So let's head over and look at the economic chart. This is what happened last week. It was a pretty jam-packed week. When it's in the red, that means that these are like high impact events that are likely to move the market. And we saw that some of these events didn't really move the market so much. And there was one event in particular at the end of the week that really impacted the market. That was this orange color, which is kind of this medium impact. So, take that with a grain of salt. Let's see. The things that are probably of interest to us. Let's go through this. Well, Jolt's job opening. So this is essentially like looking at the total number of job openings. Yeah. Let's see. Number of job openings during the reported month. Okay. So this is for February. No, this is going to be for January. So 7.6 million when it was an expected 8 million. So previously, it was 8.16 million, so it looks like there are fewer jobs available. Anecdotally, ask most people, right, that are unemployed. It seems like it's pretty dang hard to get a job these days. So that's just anecdotally, but the data does suggest that is the case. Curiously though, when we scroll down, let's see, the unemployment rate came in lower than expected. It was 4% rather than 4.1%. That came in Friday at 8:30. The average hourly earnings month over month, so for the month of January, also ticked up to 0.5%. So that was a 0.5% increase, I believe. Change in the price businesses pay for labor. Okay, so average hourly earnings month over month, that is coming up. The consensus was 0.3%. 0.5%. So it looks like unemployment is coming down. People are earning more. The unemployment rate, because we do see things like the unemployment claims and the job openings, which suggest that, is it hard out there to find a job if you don't have one? Looks like it. 219,000 were the unemployment claims. I want to say that's also, all right, for the past week, okay? So, 219K and 7.6 million when it was expected to be 8 million. So, a little tough out there. It's hard right now for sure, especially with the price of those eggs, right? Let's see. So, what else is important? This is an not inflationary. This is an inflation metric, PMI, which is Purchasing Managers Index, I believe it is. Let's see. Where does it say that? Purchasing Managers Index. Yep. So this is, it's looking at the services paid for purchasing managers. And I believe that, you know what? I think I might have gotten that wrong. Is that an inflation metric? It's more like an economic health. So it looks like purchasing managers, the services, they're coming down. So it looks like, I believe that this information is telling us that. Okay, sorry about that, guys. It looks like PMI. So this is the kind of like the report for purchasing managers, looking at the services side of things. It looks like the numbers are coming down, so I believe that's less services. That could be wrong. If I'm wrong, fact check me, please. Tell me I'm wrong. Let me know why. Okay. Let's see. Okay. This is kind of an interesting thing. I did not see this until right this second, but mortgage delinquencies. I have heard. I don't have the data on this, but I have heard that credit card debt is at an all-time high right now. And if we look at mortgage delinquencies, what is this? What's the time frame for this? During the previous quarter, so quarter to quarter, delinquencies rose from 3.92% to 3.98%. That's interesting. That's something to keep an eye on. So we will investigate that next quarter. This is really what shocked the market. So let's go back to this chart. We'll go down to an hourly time frame. Let's go to 15 minutes. If we go to Friday, so let's see. this was coming up. Huh. Okay. Well, this isn't going to be reflected in the 10-year as much, but if we looked at the overall stock market, which we can do that real quick. Let's see this time frame. Friday. Okay. So this was Friday. And when we look at the stock market, we see that at the 10 a.m. time frame, things have been going up, 608.13. Now this big red bar, what this means is that the price dropped dramatically. Okay, that's the volatility I was talking about. And we saw the University of Michigan inflation expectations. So this is a survey of 420 consumers asking about their expectations for inflation. That came in at a whopping 4.3% for inflation. Previously, it was 3.3%. So pretty drastically different, and that really dropped down the U.S. stock market. We didn't see as big of an effect in the 10-year yield, but we could potentially see the impacts of that lately. Not necessarily this inflation expectations, but just inflation as a whole. That's kind of been the big concern lately, that inflation is going up and it is not going down like the Fed would like, so there's no reason to cut rates. Really don't want to see inflation go up, right? Not good for anybody. And of course, with Trump tariffs on the table, it's looking like potentially there's going to be more inflation. It really depends. It's hard to know. It's really hard to know. It's week to week. There's different things that come up. So really, we just got to keep our eyes open. Okay, this week, is there anything huge coming up? Tuesday at 10 a.m., Powell, Jerome Powell, who is the chair of the Fed, will testify, which I believe this is like a semi-annual thing that happens. Not a huge deal in the sense of him testifying, but it's before the Senate Banking Committee. We could see volatility there. We could see the 10-year yield drop, come up. I could see it potentially going up if investors get spooked and want to pull their money out of the bond market. So that's something to watch out for at the 10 a.m. time frame. CPI month over month. This is one of the metrics that the Fed likes to use for inflation as a proxy. I believe they like the PCE better, but CPI is something to watch year over year. This is the Consumer Price Index, and it is measuring a basket of goods. The core CPI excludes volatile goods such as food and energy, and CPI has those volatile goods in there. So we are going to look out for that. Unemployment claims, we will keep looking out for that to see if unemployment's going up, going down. This 10-year bond auction, that might be interesting to look at, so we will keep an eye on that. The Cleveland Fed inflation expectations, that might be interesting also to look at. Really, inflation is just that's the big thing right now. That's what is spooking investors. As investors get concerned, they may pull their money out of the bond market. When they pull their money out of the bond market, the 10-year yield typically goes up. Remember that inverse relationship. The yield is there because it is supposed to attract investors to invest into the bond market. Whenever the yield is rising, that is more lucrative to investors to invest in bonds. And that's the reason that yield would rise. At least one of the reasons. And inflation concerns, one could argue that with inflation concerns, potential recession concerns, that investors would just withdraw their money and they'd rather have cash. But if the yield gets high enough, one could also argue that bonds are a flight to safety, that they are a risk-off asset. They aren't as risky, so they may invest their money in the bond market. If that is the case, then the yield could come down. All right, so let's see. Let's finish off with just looking at the numbers. 6.89. See, okay, if you made it all the way in, you saw that I was wrong in the intro video, so congratulations. I don't know how many people are listening, but if you are, then this is for you. It was all worth it, right? 6.89 is the average 30-year fixed. That is down from 6.95 a week ago. And we had our latest high, which just, if we're looking at a smaller time frame, 7.04% back in January 16th. It is coming down. Just looking at that unemployment rate again. Unemployment ticking up a little bit, coming down to 4%. Hopefully we can get that unemployment down. I will say there is a weird relationship right now with the Fed where when unemployment information and data is good, it gives the Fed more leeway to hold rates higher for banks. As rates are held higher for banks, this is less attractive for investors. Investors were pricing in and expecting, at first it was 4 rate cuts, and then in December, investors found out it was only going to be 2 rate cuts. I believe they're pricing in 1 rate cut right now for 2025. If that gets down to 0, might not be good news. So there's a weird relationship between unemployment and inflation right now. If inflation keeps heading to the upside and unemployment heads to the downside, then the Fed really doesn't have much of a reason to cut rates, and they might even hike rates, which could be fairly detrimental to the market as a whole, as investors are not pricing that in and expecting that, which theoretically could shoot the 10-year yield up. Definitely want to keep an eye out for that. That's everything that I had for you this week. Stay safe out there. If you guys are looking for a mortgage, have any mortgage questions, have any questions about refinancing, we saw that the rates are coming down a little bit, so it might be a good time to refinance. Might be a good time to also do a HELOC if you aren't aware of what those are, pulling the equity out of your home. If you have a good bit of equity, the rates could be lower than your credit card rates, where evidently we have all-time highs for credit card debt. So if you have a lot of debt, might be a good idea to do a HELOC. All right, give us a call at 904-591-3662 or visit us at mortgagesbylinda.com, and we will help you out with all of your mortgage needs. Stay safe out there and have a great week.